What is the purpose of capital budgeting? The purpose of capital budgeting is to determine which long-term investments are worth pursuing. What is another term used for capital budgeting? Capital budgeting is also known as investment appraisal. How is NPV affected by the discount rate? NPV is greatly affected by the discount rate. A higher discount rate will result in a lower NPV and vice versa. What is the capital asset pricing model, CAPM, estimate for each project? CAPM estimates the appropriate discount rate for each project based on its riskiness. What is the key drawback of the payback period method? The payback period method does not consider the time value of money, risk, financing, or other important factors. Define the internal rate of return, IRR. The internal rate of return, IRR, is the discount rate that makes the net present value, NPV, of a project equal to zero. When will the IRR method lead to the same decision as the NPV method? The IRR method will lead to the same decision as the NPV method for non-mutually exclusive projects in an unconstrained environment. What is the main advantage of the Profitability Index PI method? The Profitability Index allows ranking projects based on the value created per unit of investment. How does the equivalent annuity method handle projects with unequal lifespans? The equivalent annuity method annualizes the net present value, NPV, by dividing it by the present value of the annuity factor. What does real options analysis attempt to value? Real options analysis attempts to value the managerial choices or options in the future for a given project. What does the modified internal rate of return, MIRR, resolve in comparison to the IRR? The MIRR resolves some issues with the IRR method and provides a more accurate representation of investment attractiveness. How does the Profitability Index PI differ from the payback period method? The Profitability Index considers the present value of cash flows, while the payback period does not. Explain the concept of the hurdle rate in capital budgeting. The hurdle rate is the minimum rate of return required for a project to be considered acceptable. What is the primary advantage of the net present value, NPV, method over the payback period method? The NPV method considers the time value of money, making it a more reliable measure of investment profitability. What is the main limitation of using the internal rate of return, IRR, as a decision criterion? The IRR method may lead to conflicting decisions for mutually exclusive projects with different cash flow patterns. How does the equivalent annuity method compare projects with different lifespans? The equivalent annuity method converts the NPV of projects into an annualized cash flow, allowing for direct comparison. What is the primary difference between the Profitability Index PI and the profit margin ratio? The Profitability Index measures the value created per unit of investment, while the profit margin ratio measures the profitability of sales. What are the major techniques used in capital budgeting based on accounting earnings? Techniques based on accounting earnings include return on investment (ROI) and accounting rate of return (ARR). In capital budgeting, what is the role of the weighted average cost of capital (WACC)? WACC is used to determine the discount rate for projects based on the financing mix of the company. How does the Profitability Index handle projects with different initial investments? The Profitability Index normalizes the value created by a project with respect to its initial investment. What is the purpose of real options analysis in capital budgeting? Real options analysis accounts for the managerial flexibility and future choices associated with the project. What is the main drawback of using payback period as the sole decision criterion for projects? The payback period does not consider the cash flows occurring after the payback period, leading to incomplete decision-making. What is the arbitrage pricing theory, APT, model in finance attempt to model? The APT model attempts to model the expected return of a financial asset as a linear function of various macroeconomic factors. How does the modified internal rate of return, MIRR, address the shortcomings of the traditional IRR? MIRR resolves the issue of multiple IRRs and considers both the reinvestment rate and the finance rate. Capital budgeting. What does the term mutually exclusive projects mean? Mutually exclusive projects are projects that cannot be undertaken simultaneously due to their nature or resource constraints. How is the hurdle rate determined for a capital budgeting project? The hurdle rate is determined based on the required rate of return, which takes into account the project's risk and the cost of capital. Which method of capital budgeting is most commonly used in practice and why? Net present value, NPV, is most commonly used because it considers the time value of money and provides a clear measure of project profitability. What is the primary purpose of using real options analysis in capital budgeting? Real options analysis allows managers to value the strategic choices and opportunities associated with a project. What is the relationship between NPV and IRR for mutually exclusive projects? For mutually exclusive projects, the NPV and IRR methods may lead to conflicting decisions. Define the concept of opportunity cost in capital budgeting. Opportunity cost refers to the value of the next best alternative foregone when a particular investment is chosen. How is the hurdle rate determined in practice for a capital budgeting project? The hurdle rate is determined based on the cost of capital and the risk associated with the project. What are the main disadvantages of using the payback period method for project evaluation? The payback period method does not consider the time value of money, making it less accurate than other methods. Name 2 techniques used for capital budgeting based on discounted cash flows. 2 techniques based on discounted cash flows are net present value, NPV, and internal rate of return, IRR. How does the net present value, NPV, method account for risk in a capital budgeting project? The NPV method accounts for risk by using a discount rate that reflects the project's riskiness. What are the critical factors to consider when selecting a discount rate for a project using the NPV method? The critical factors include the riskiness of the investment, the cost of capital, and the financing mix. What does the term investment appraisal mean in the context of capital budgeting? Investment appraisal refers to the evaluation of long-term investment opportunities to determine their worthiness. Explain the concept of equivalent annuity in capital budgeting. The equivalent annuity method converts the NPV of a project into an annual cash flow, making it easier to compare projects with different lifespans. What is the purpose of using real options analysis in addition to traditional capital budgeting techniques? Real options analysis helps capture the value of managerial flexibility and future decision-making options associated with a project. How does the Profitability Index (PI) help in ranking investment projects? The Profitability Index allows for the ranking of investment projects based on the value created per unit of investment. What is the relationship between the Profitability Index (PI) and net present value, NPV, for mutually exclusive projects? For mutually exclusive projects, the Profitability Index and NPV methods will yield the same ranking of projects. How does the net present value, NPV, method handle the timing of cash flows in a capital budgeting project? The NPV method discounts all the future cash flows to the present, taking into account their respective timings. What are the major limitations of the payback period method for project evaluation? The payback period method does not account for the time value of money, cash flows beyond the payback period, or risk factors. What are the main components of the Capital Asset Pricing Model, CAPM? The main components of CAPM are the risk-free rate, market risk premium, and beta, which measures the asset's sensitivity to market movements. How does the Modified Internal Rate of Return, MIRR, differ from the traditional IRR method? The MIRR method addresses the issue of multiple IRRs and provides a more realistic assessment of investment profitability. What is the primary advantage of the net present value, NPV, method over the Profitability Index (PI) method? The NPV method considers the actual dollar value of the project, while the PI only provides a relative ranking of projects. Explain the concept of discounted cash flow in capital budgeting. Discounted cash flow is a method of valuation that discounts future cash flows to their present value using a chosen discount rate. How does the Profitability Index (PI) account for projects with different initial investments? The Profitability Index normalizes the value created by a project by dividing it by the initial investment. In capital budgeting, why is the equivalent annuity method used for projects with unequal lifespans? The equivalent annuity method annualizes the NPV, allowing for a direct comparison between projects with different lifespans. What is the primary advantage of using the real options analysis in addition to traditional capital budgeting techniques? Real options analysis considers the value of managerial flexibility and strategic choices, enhancing the decision-making process. How does the payback period method handle projects with multiple cash flow changes? The payback period method considers only the time taken to recover the initial investment, disregarding cash flows beyond that point. What is the primary limitation of using the accounting rate of return (ARR) method in capital budgeting. The ARR method uses accounting earnings rather than cash flows and may not accurately reflect a project's profitability. How does the net present value (NPV) method account for inflation in capital budgeting? The NPV method uses a discount rate that factors in inflation, thereby adjusting the future cash flows to their present value. What is the role of the weighted average cost of capital (WACC) in determining a discount rate for capital budgeting projects? WACC is used to calculate the discount rate, which represents the average cost of capital for a company. Explain the concept of the discount rate in capital budgeting. The discount rate is the rate used to convert future cash flows into their present value to account for the time value of money. What are the major advantages of using the net present value (NPV) method for project evaluation? The NPV method accounts for the time value of money, provides an absolute measure of profitability, and considers all cash flows. How does the profitability index (PI) differ from the return on investment (ROI) method? The PI considers the present value of cash flows, while the ROI focuses on the profitability of a project based on accounting earnings. How does the net present value (NPV) method handle the risk associated with capital budgeting projects? The NPV method incorporates risk by using a discount rate that reflects the project's riskiness. In capital budgeting, how is the weighted average cost of capital (WACC) calculated? WACC is calculated as the weighted average of the cost of equity and the cost of debt, taking into account the respective weights in the capital structure. What are the main advantages of using the net present value (NPV) method over the payback period method? The NPV method accounts for the time value of money and provides a clear measure of investment profitability. How does the net present value (NPV) method handle projects with multiple cash flow changes? The NPV method considers all cash flows and discounts them to their present value, accounting for the time value of money. What is the primary drawback of using the accounting rate of return (ARR) method in capital budgeting? The ARR method does not consider the time value of money and uses accounting earnings, which may not reflect cash flows accurately. What is the purpose of capital budgeting? The purpose of capital budgeting is to determine the value and profitability of potential investment projects for a company. What are the three most common approaches to project selection in capital budgeting? The three most common approaches to project selection are payback period (PB), internal rate of return (IRR), and net present value (NPV). How does the payback period help in making investment decisions? The payback period calculates the time required for a company to recover its original investment in a project, aiding in the decision-making process. Explain the internal rate of return (IRR) and its significance in capital budgeting. The internal rate of return (IRR) is the expected return on a project. If the IRR is higher than the cost of capital, the project is considered favorable. How is net present value (NPV) used to assess the profitability of a project? Net present value (NPV) compares the present value of a project's cash inflows and outflows. A positive NPV indicates a profitable investment. Why do companies need capital budgeting? Companies need capital budgeting to assess risks, plan ahead, and predict challenges before making long-term financial commitments. What are the unique challenges faced in capital budgeting compared to operational budgeting? Capital budgets are often cost centers, funded from external sources, and involve more risks and uncertainties due to their long-term nature. How do discounted cash flow techniques help in capital budgeting? Discounted cash flow techniques consider the time value of money and assess cash flow timing and dollar implications in long-term projects. In what situations is payback analysis a preferred method for capital budgeting decisions? Payback analysis is preferred when liquidity is a significant concern for companies with limited funds to undertake multiple projects. What is the primary advantage of using internal rate of return (IRR) as a decision-making tool in capital budgeting? IRR provides a benchmark figure that can be compared against a company's cost of capital to assess project profitability. Explain the drawbacks of using the payback method in capital budgeting decisions. The payback method ignores the time value of money, does not consider cash flows at the end of a project's life, and may not be suitable for projects with unconventional cash flows. How does the net present value (NPV) approach differ from the internal rate of return (IRR) method in capital budgeting? The NPV approach provides a direct measure of added profitability and allows for a comparison of mutually exclusive projects, while IRR may lead to contradictory results for such projects. What is the Profitability Index (PI), and how does it complement the Net Present Value (NPV) approach in capital budgeting? The Profitability Index is calculated by dividing the present value of future cash flows by the initial investment, helping to assess investment quality in conjunction with NPV. Which types of budgets are commonly used for capital budgeting? Capital budgets can be prepared using incremental, activity-based, value proposition, or zero-based budgets, with zero-based budgets being most appropriate for new projects. How do capital budgets differ from operational budgets in terms of timeframes and scope? Capital budgets are long-term plans covering multiple years, focusing on investments and major purchases, whereas operational budgets are one-year plans centered on revenue and expenses for day-to-day activities. Are companies required to disclose their capital budgets to the public? No, capital budgets, like all other budgets, are internal documents used for planning and are not required to be disclosed to the public. What are the benefits of using discounted cash flow analysis in capital budgeting? Discounted cash flow analysis helps in considering the time value of money and evaluating the implications of cash flows in long-term projects. How does the payback period method help companies with limited funds? The payback period method helps companies assess how long it takes to recover their initial investment, which is essential when dealing with limited funds for multiple projects. Why is the net present value (NPV) method considered the most effective approach to capital budgeting? The NPV method provides a direct measure of added profitability and allows for a comparison of mutually exclusive projects, making it a more comprehensive approach. What types of risks and uncertainties are typically associated with capital budgets? Capital budgets involve more risks and uncertainties due to their long-term nature, which can include changes in market conditions, technology, and regulatory environment. Describe the importance of capital budgeting in strategic decision-making for companies. Capital budgeting allows companies to make informed decisions about long-term investments, which can significantly impact their future direction and profitability. What are the key components of discounted cash flow analysis in capital budgeting? The key components of discounted cash flow analysis include cash flow timing, implications of the dollar value over time, and determining a target discount rate. How do companies use payback analysis to gauge the success of their investments? Payback analysis helps companies track the timing of when certain benchmarks are achieved, such as breaking even or reaching a specific amount of profit. Does the internal rate of return (IRR) rule state, and how does it guide investment decisions? The IRR rule states that a project with an IRR higher than the cost of capital should be accepted, indicating that it is a profitable endeavor. How does the net present value (NPV) approach help companies in comparing multiple investment projects? The NPV approach provides a direct measure of profitability, enabling companies to compare and rank investment projects based on their expected added value. Explain the concept of incremental budgets and how they relate to capital budgeting. Incremental budgets build upon existing baselines from prior year budgets, which can be useful when assessing incremental changes in capital budgeting projects. What is the significance of value proposition budgets in capital budgeting decisions? Value proposition budgets help companies evaluate the value added by different investment projects, aiding in decision-making for the most advantageous endeavors. How do companies use zero-based budgets in capital budgeting for new projects? Zero-based budgets start from scratch and require a justification for each expense, making them suitable for new projects that need thorough evaluation. How do operational budgets differ from capital budgets in terms of financial focus? Operational budgets primarily focus on revenue and expenses related to day-to-day activities, while capital budgets concentrate on larger financial outlays and long-term projects. What are the potential consequences for a company that fails to engage in capital budgeting? A company that fails to engage in capital budgeting may make uninformed investment decisions, leading to financial losses, missed opportunities, and decreased competitiveness in the market. How do companies determine the cost of capital used in internal rate of return (IRR) calculations? The cost of capital used in IRR calculations is typically the actual rate the company uses to discount after-tax cash flows. What is the primary advantage of using the net present value (NPV) approach in capital budgeting? The NPV approach provides a direct measure of profitability and allows for a comprehensive comparison of different investment projects. How does sensitivity analysis help in capital budgeting? Sensitivity analysis in capital budgeting examines the impact of potential changes in key variables on the project's profitability. allowing for better decision-making. Explain the concept of throughput analysis in capital budgeting. Throughput analysis involves analyzing revenue and expenses across the entire organization, not just for specific projects, to determine profit earned from each sale. How can companies use throughput analysis for operational budgeting? Throughput analysis can be used in operational budgeting by analyzing revenue and expenses to calculate profits and identify funds available for covering operational expenses. What is the significance of the weighted average cost of capital, WACC, in capital budgeting decisions? The weighted average cost of capital, WACC, is a crucial factor in determining the investment quality of projects in capital budgeting. How can companies use the Profitability Index (PI) to assess the value of capital budgeting projects? The Profitability Index (PI) is calculated by dividing the present value of future cash flows by the initial investment, providing a measure of the project's value. How does zero-based budgeting aid companies in evaluating new investment endeavors? Zero-based budgeting starts from scratch and requires justification for each expense, making it ideal for thorough evaluation of new capital budgeting projects. Explain how capital budgets help companies plan for long-term financial outlays. Capital budgets help companies proactively plan and allocate resources for long-term financial outlays, such as investments and major purchases. How do companies use discounted cash flow analysis to assess the financial implications of projects over time? Discounted cash flow analysis considers the time value of money and calculates the present value of future cash flows, enabling better evaluation of project profitability over time. What factors should companies consider when conducting payback analysis? Companies should consider accurate cash flow forecasts and the potential for deviations in estimating cash flows while conducting payback analysis. Why is the net present value (NPV) method considered more comprehensive than the payback method? The NPV method provides a direct measure of added profitability and incorporates the time value of money, making it more comprehensive than the payback method. How do mutually exclusive projects differ from non-mutually exclusive projects in capital budgeting? Mutually exclusive projects are projects where selecting one precludes the selection of others, whereas non-mutually exclusive projects can be combined and pursued together. What challenges may arise when using the internal rate of return (IRR) method for projects with unconventional cash flows? Projects with unconventional cash flows may lead to multiple internal rates of return (IRR) or render an IRR non-existent, making the method less suitable for such projects. How can companies use the Profitability Index (PI) to make decisions in capital budgeting? Companies can use the Profitability Index (PI) to assess the value of investment projects by comparing the present value of future cash flows to the initial investment. How does the net present value (NPV) method address the time value of money in capital budgeting? The net present value (NPV) method discounts future cash flows to their present value, factoring in the time value of money in project evaluation. What challenges might companies face when calculating the weighted average cost of capital (WACC)? Companies may face challenges in calculating the weighted average cost of capital due to complexities in determining appropriate discount rates and cost components. How does capital budgeting aid companies in strategic planning for the future? Capital budgeting allows companies to plan and allocate resources strategically for long-term investments, aligning with their future objectives. What are the benefits of incorporating sensitivity analysis in capital budgeting decisions? Sensitivity analysis helps companies assess the impact of changes in key variables on project profitability, enabling better risk management and decision-making. How can companies use discounted cash flow analysis to make informed decisions about long-term projects? Discounted cash flow analysis aids companies in evaluating the timing and financial implications of long-term projects, guiding their investment decisions. How does incremental budgeting help companies in capital budgeting decisions? Incremental budgeting builds upon existing baselines from prior year budgets, allowing companies to assess incremental changes and plan for future capital expenditures accordingly. How do companies determine the discount rate used in discounted cash flow analysis for capital budgeting? Companies typically determine the discount rate by considering the cost of capital or the required rate of return for the project. Why is zero-based budgeting well suited for new capital budgeting projects? Zero-based budgeting requires a justification for each expense and starts from scratch, making it ideal for evaluating new capital budgeting projects. What are the potential risks associated with capital budgets that span multiple years? Capital budgets that span multiple years are more susceptible to risks and uncertainties due to changes in market conditions, technology, and regulations. How does discounted cash flow analysis consider the implications of the dollar value over time in capital budgeting? Discounted cash flow analysis accounts for the time value of money, considering that a dollar today has a higher value than a dollar in the future. How can companies use sensitivity analysis to manage potential risks in capital budgeting? Sensitivity analysis helps companies identify how changes in key variables may affect project profitability, allowing them to mitigate potential risks. Why is the weighted average cost of capital, WACC, a crucial consideration in capital budgeting decisions? The weighted average cost of capital, WACC, is essential because it represents the cost of financing the project and influences the project's overall profitability. How does capital budgeting help companies in achieving their long-term financial goals? Capital budgeting allows companies to allocate resources strategically for long-term investments, supporting their financial goals and growth plans. How can companies use the Profitability Index (PI) to prioritize capital budgeting projects? Companies can use the Profitability Index (PI) to rank capital budgeting projects based on their value proposition and potential added profitability. What potential challenges might companies face when using the internal rate of return (IRR) method for capital budgeting? Companies may face challenges with unconventional cash flows, leading to multiple internal rates of return (IRR), or rendering the IRR non-existent for certain projects. How can companies use discounted cash flow analysis to assess the long-term financial implications of capital budgeting projects? Discounted cash flow analysis helps companies evaluate the long-term financial implications of projects by considering the time value of money and cash flow timing. How does incremental budgeting aid companies in planning for future capital expenditures? Incremental budgeting builds upon existing baselines, allowing companies to assess incremental changes and plan for future capital expenditures accordingly. How do sensitivity analysis and scenario analysis differ in their applications in capital budgeting? Sensitivity analysis assesses the impact of changes in single variables, while scenario analysis considers multiple variables to assess various outcomes. What factors should companies consider when evaluating mutually exclusive capital budgeting projects? When evaluating mutually exclusive projects, companies should compare the NPV, IRR, and other relevant metrics to determine the most favorable option. How do capital budgets differ from operational budgets in terms of financial focus and timeframes? Capital budgets focus on long-term financial outlays and investments, spanning multiple years, while operational budgets concentrate on day-to-day revenue and expenses for a one-year period. How can sensitivity analysis help companies in assessing the viability of capital budgeting projects in changing market conditions? Sensitivity analysis helps companies evaluate how project profitability may change under different market conditions, enabling better decision-making and risk management. What considerations should companies make when conducting discounted cash flow analysis for capital budgeting? Companies should carefully assess cash flow timing, discount rates, and implications of the dollar value over time when conducting discounted cash flow analysis. How does payback analysis help companies with limited financial resources in capital budgeting decisions? Payback analysis helps companies determine how long it takes to recoup their initial investment, aiding in prioritizing projects with limited financial resources. Why is the net present value, NPV, method considered more comprehensive than the payback period method? The NPV method factors in the time value of money and provides a direct measure of added profitability, making it more comprehensive than the payback period method. How can companies use the Profitability Index (PI) to assess the value of capital budgeting projects over time? The Profitability Index (PI) considers the present value of future cash flows in relation to the initial investment, helping companies assess the project's value over time. How does sensitivity analysis help companies in managing potential risks and uncertainties in capital budgeting decisions? Sensitivity analysis allows companies to assess how changes in key variables may affect project profitability, enabling better risk management. What is the primary purpose of capital budgeting? The primary purpose of capital budgeting is to determine the worthiness of long-term investment projects and allocate resources accordingly. What are the main goals of capital budgeting? The main goals of capital budgeting are to rank projects based on their financial viability and to raise funds for investment opportunities. Which funding sources are generally available to publicly traded corporations during capital budgeting? Publicly traded corporations can acquire funds through corporate bonds, preferred stock, and common stock. How does capital budgeting differ from the overall budgeting process? Capital budgeting focuses on long-term investment decisions and major capital expenditures, while overall budgeting covers the financial forecast for the entire business. What role do private equity firms play in capital budgeting? Private equity firms, such as NBGI Private Equity, provide funds to companies that may not want to obtain funds publicly. How does the Profitability Index (PI) aid in ranking projects in capital budgeting? The Profitability Index ranks projects based on the value created per unit of investment, helping to identify the most financially rewarding projects. What is the implication of making long-term investment decisions in capital budgeting? Long-term investment decisions involve larger sums of money and have extensive implications due to the time factor and risk involved. How do capital budgeting decisions differ from short-run decisions? Capital budgeting decisions are subject to higher risk and uncertainty compared to short-run decisions due to the long-term nature of investments. What is the relationship between the internal rate of return (IRR) and the net present value (NPV) in capital budgeting? The IRR is the discount rate that makes the NPV of all cash flows from an investment equal to zero. What are the core tools used in capital budgeting for understanding and estimating cash flows? Core tools for understanding and estimating cash flows include the internal rate of return (IRR) and the net present value (NPV). What does the term accounting flows refer to in the context of capital budgeting? Accounting flows are the processes used to identify and record business transactions related to assets, liabilities, and equity. How do cash flows analyses aid in capital budgeting? Cash flow analyses help determine the profitability, cost of capital, and expected rate of return on a project or investment. What activities are included in cash flows analyses? Cash flows analyses include investing activities, operating activities, and financing activities. How does the net present value (NPV) calculation take future cash flows into account in capital budgeting? The NPV discounts all future cash flows to their present value based on the weighted average cost of capital. Why is understanding cash flow important in capital budgeting? Understanding cash flow is essential in capital budgeting as it helps evaluate the overall profitability, liquidity, and rate of return on a project. What are the key differences between common stock and preferred stock in capital budgeting? Common stock represents corporate equity ownership, while preferred stock is considered a hybrid instrument with properties of both equity and debt. How do investing activities contribute to cash flows in capital budgeting? Investing activities involve cash flows related to mergers, acquisitions, loans, and the purchase or sale of assets. What are the three methods available to publicly traded corporations for raising funds in capital budgeting? Publicly traded corporations can raise funds through corporate bonds, preferred stock, and common stock. How does capital budgeting aid in ranking projects? Capital budgeting helps rank projects by evaluating their financial attractiveness and profitability, enabling the selection of the most promising projects. What is the purpose of the weighted average cost of capital (WACC) in capital budgeting? WACC is used to calculate the discount rate for projects, reflecting the average cost of capital for a company. How does the Profitability Index (PI) differ from the internal rate of return (IRR) in capital budgeting? The PI quantifies the value created per unit of investment, while the IRR is the rate that makes the NPV of cash flows equal to zero. What is the role of the International Accounting Standards (IS) and the Generally Accepted Accounting Principles (GAAP) in accounting flows? IAS and GAAP provide legislative descriptions and norms for accounting practices, ensuring consistency and adherence to financial reporting standards. What is the importance of conducting cash flow analyses in capital budgeting? Cash flow analyses help estimate the rate of return, value, and overall profitability of a project or investment. How does understanding cash flow assist in evaluating the liquidity of a business in capital budgeting? Understanding cash flow allows for an assessment of the company's capacity to capture existing opportunities and invest in future projects. What activities fall under operating activities in cash flow analyses for capital budgeting? Operating activities include all transactions related to the production, sale, or delivery of a product or service. How do investing activities affect cash flows in capital budgeting? Investing activities involve cash flows related to mergers, acquisitions, loans, and the purchase or sale of assets. What are the core components of capital budgeting? The core components of capital budgeting include cash flow analyses, ranking projects, and raising funds through various methods. How does capital budgeting provide visibility into a company's performance? Capital budgeting allows managers to measure the actual financial performance of the business against forecasted projections. What is the primary function of the Profitability Index (PI)? In capital budgeting, the PI ranks projects based on the value they create per unit of investment, helping to prioritize the most profitable ventures. What are the major factors considered when determining the cost constraint for a project in capital budgeting? The major factors include the available budgeted capital and the financial performance expectations for the project. What are the key steps in the capital budgeting process? The key steps include identifying potential projects, estimating cash flows, evaluating project risks, and ranking projects based on financial metrics. How does capital budgeting help in raising funds for projects? Capital budgeting determines the appropriate mix of financing sources, such as corporate bonds, preferred stock, and common stock. What is the significance of understanding cash flows in capital budgeting? Understanding cash flows is crucial for estimating project profitability and assessing a company's financial health. What are the major limitations of the payback period method in capital budgeting? The payback period method does not consider the time value of money or cash flows beyond the payback period. How do capital budgeting decisions affect a company's long-term financial position? Capital budgeting decisions influence a company's long-term financial position by determining investment outcomes. How does the net present value (NPV) method account for risk in capital budgeting? The NPV method accounts for risk by using a discount rate that reflects the project's riskiness. What are the critical factors to consider when selecting a discount rate for a project using the NPV method? The critical factors include the riskiness of the investment, the cost of capital, and the financing mix. What does the term investment appraisal mean in the context of capital budgeting? Investment appraisal refers to the evaluation of long-term investment opportunities to determine their worthiness. What is the purpose of using real options analysis in addition to traditional capital budgeting techniques? Real options analysis helps capture the value of managerial flexibility and future decision-making options associated with a project. How does the Profitability Index (PI) help in ranking investment projects? The Profitability Index allows for the ranking of investment projects based on the value created per unit of investment. What is the relationship between the Profitability Index (PI) and net present value (NPV) for mutually exclusive projects? For mutually exclusive projects, the Profitability Index and NPV methods will yield the same ranking of projects. How does the net present value (NPV) method handle the timing of cash flows in a capital budgeting project? The NPV method discounts all the future cash flows to the present, taking into account their respective timings. What are the major limitations of the payback period method for project evaluation? The payback period method does not account for the time value of money, cash flows beyond the payback period, or risk factors. What are the major advantages of using the net present value (NPV) method for project evaluation? The NPV method accounts for the time value of money, provides an absolute measure of profitability, and considers all cash flows. How does the Profitability Index (PI) differ from the Return on Investment (ROI) method? The PI considers the present value of cash flows, while the ROI focuses on the profitability of a project based on accounting earnings. What is the primary drawback of using the accounting rate of return (ARR) method in capital budgeting? The ARR method does not consider the time value of money and uses accounting earnings, which may not reflect cash flows accurately. How does the net present value (NPV) method handle the risk associated with capital budgeting projects? The NPV method incorporates risk by using a discount rate that reflects the project's riskiness. In capital budgeting, how is the weighted average cost of capital (WACC) calculated? WACC is calculated as the weighted average of the cost of equity and the cost of debt, taking into account the respective weights in the capital structure. What are the main advantages of using the net present value (NPV) method over the payback period method? The NPV method accounts for the time value of money and provides a clear measure of investment profitability. How does the net present value (NPV) method handle projects with different lifespans? The NPV method compares projects with different lifespans by discounting their cash flows to their present value. How does the accounting flow relate to the overall financial operations of a business? Accounting flow tracks the inflows and outflows of assets, capital, and resources, providing a clear picture of the financial operations of a business. What factors should financial managers consider when determining the ideal funding mix in capital budgeting? Financial managers consider the financial risk of the corporation and the cost of capital when determining the ideal funding mix. How does capital budgeting enable managers to consider problems before they arise? Capital budgeting requires managers to forecast potential scenarios, allowing them to address issues proactively before they become problems. What is the main purpose of constructing a budget in capital budgeting? The main purpose of constructing a budget is to provide a financial forecast for the business's performance and guide decision-making. How do cash flows analyses aid in evaluating the profitability of a project? Cash flow analyses help determine the rate of return, net present value, and overall profitability of a project. What is the significance of capital budgeting decisions in terms of risk and uncertainty? Capital budgeting decisions involve higher risk and uncertainty due to the long-term nature of investments and their potential impacts on a company's financial performance. How does the net present value, NPV, method help in assessing the financial viability of an investment? The NPV method considers all cash flows and discounts them to their present value, providing an estimate of the project's overall financial worth. What is the role of preferred stock in capital budgeting financing activities? Preferred stock represents an equity security that carries characteristics of both equity and debt, providing an alternative source of financing. How does capital budgeting assist in coordinating the activities of an organization? Capital budgeting compels managers to evaluate relationships between their own operations and other departments, leading to better coordination. What are the major advantages of using the weighted average cost of capital, the WACC, in capital budgeting? WACC helps determine the discount rate and reflects the company's cost of capital, enabling better project evaluations. How does capital budgeting impact the profitability of a company? Capital budgeting decisions can significantly impact the profitability of a company by selecting the most financially rewarding projects. How do cash flows analyses assist in evaluating a business's overall liquidity? Cash flows analyses provide insights into a business's capacity to capture opportunities by freeing up capital for future investments. What is the primary role of accounting flows in financial reporting and budgeting? Accounting flows track and record business transactions to create financial statements and aid in budgeting and forecasting. How does capital budgeting enable organizations to prioritize projects based on financial viability? Capital budgeting evaluates the financial attractiveness of projects, enabling organizations to rank and select the most promising ventures. How does the Profitability Index (PI) aid in determining the most profitable projects in capital budgeting? The Profitability Index allows for the ranking of investment projects based on the value created per unit of investment. What does the internal rate of return, IRR, represent in capital budgeting? The IRR represents the rate of return that makes the NPV of cash flows from an investment equal to zero. How do cash flow analyses contribute to understanding and estimating the value of a project in capital budgeting? Cash flow analyses, such as the net present value, NPV, and internal rate of return, IRR, help estimate the value and profitability of a project. How does capital budgeting aid in controlling resources? Capital budgeting sets a cost constraint for projects, ensuring that resources are allocated efficiently. What are the major limitations of using the payback period method for project evaluation? The payback period method does not account for the time value of money, cash flows beyond the payback period, or risk factors. What is the primary purpose of using real options analysis in capital budgeting? Real options analysis accounts for the value of managerial flexibility and the strategic choices associated with a project. How does the net present value, NPV, method handle projects with multiple cash flow changes? The NPV method considers all cash flows and discounts them to their present value, accounting for the time value of money. What are the main drawbacks of using the payback period method for project evaluation? The payback period method does not account for the time value of money or cash flows beyond the payback period. What is the purpose of capital budgeting in financial decision-making? Capital budgeting helps rank investment proposals and choose the most valuable investment option by using various evaluation methods. How does a higher NPV impact the desirability of an investment proposal? A higher NPV indicates a more attractive investment proposal with greater potential for generating positive cash flows. What does a higher IRR value suggest about an investment project? A higher IRR value suggests a more desirable investment project with a higher expected return. How is the Profitability Index (PI) calculated, and what does it reveal about a proposed project? PI is calculated as the PV of future cash flows divided by the initial investment. A higher PI indicates a more financially attractive project. What are the limitations of the payback period method in evaluating investment proposals? The payback period method does not consider the time value of money and ignores cash flows that occur after the payback period. How does the ARR value impact the attractiveness of an investment proposal? A higher ARR value indicates a more attractive investment proposal with higher expected returns. What is discounted cash flow (DCF) analysis, and why is it a standard method for capital budgeting? DCF analysis is a method of valuing projects, companies, or assets using the concepts of the time value of money, making it standard for capital budgeting. How does the time value of money influence capital budgeting decisions? The time value of money considers the value of money over time due to interest earned or inflation, influencing project evaluations. When using NPV and PI methods, what assumptions are made about reinvestment of cash flows? NPV and PI assume reinvestment at the discount rate, reflecting the opportunity cost of investment. How does the reinvestment rate impact the selection of the discount rate in capital budgeting? The reinvestment rate depends on the objective of the analysis and the need to maximize the value of the firm or determine if a project adds value. What does a profitability index of 1 indicate, and how does it affect project acceptability? A PI of 1 indicates break-even, and a value greater than 1 means the project is acceptable. When might IRR be a suitable choice for analyzing investments, and what are its advantages? IRR is suitable for analyzing venture capital and private equity investments, as they often involve multiple cash investments and a single cash outflow. How can multiple internal rates of return (MIRR) be used to address issues with IRR? IRR can be used when a project has multiple IRRs, providing a more convenient method for computing the IRR with the benefits reinvested. What is the weighted average cost of capital (WACC), and how is it used in capital budgeting? WACC is the rate that a company is expected to pay on average to all its security holders to finance its assets, and it is used as the discount rate in capital budgeting. How does the reinvestment rate relate to the selection of the discount rate in capital budgeting? The reinvestment rate influences the selection of the discount rate, depending on the analysis objective. How does NPV account for the time value of money, and why is it important in capital budgeting? NPV accounts for the time value of money by discounting future cash flows to their present value, making it a crucial factor in capital budgeting. How does the IRR method consider the time value of money in investment evaluations? IRR considers the time value of money indirectly, as it seeks to make the NPV of cash flows equal to 0. What are the advantages of using the Profitability Index (PI) in evaluating investment proposals? PI quantifies the amount of value created per unit of investment, helping rank projects based on financial attractiveness. How can the Profitability Index (PI) assist companies in making better investment decisions? PI enables companies to compare investment projects on the basis of returns on invested capital, aiding in decision-making. What is the significance of using discounted cash flow (DCF) analysis in capital budgeting decisions? DCF analysis helps determine the present value of future cash flows and the financial viability of investment projects. How can companies use the discounted payback period method to evaluate investment proposals? The discounted payback period method helps assess how long it takes for an investment to recover its initial cost when considering the time value of money. What are the limitations of using the payback period method in investment evaluations? The payback period method ignores the time value of money and does not consider cash flows that occur after the payback period. How does sensitivity analysis assist companies in managing risks in capital budgeting? Sensitivity analysis helps evaluate how project profitability may change under different market conditions, allowing better risk management. What are the common types of budgets used in companies, and how are they related to capital budgeting? Incremental, activity-based, value proposition, and zero-based budgets are common types related to capital budgeting, with zero-based budgets being most appropriate for new endeavors. Why is capital budgeting important for businesses, and how does it impact their long-term economic and financial profitability? Capital budgeting is crucial for businesses as it helps them assess risks, plan ahead, and predict challenges before they occur, contributing to their long-term economic and financial profitability. Explain the concept of payback period and its significance in capital budgeting decisions. The payback period measures how long it takes for an investment to recover its initial cost, providing insights into project liquidity and financial recovery time. How does the NPV method help companies make more informed investment decisions? NPV provides a direct measure of added profitability, enabling companies to compare multiple mutually exclusive projects and decide which ones are most suitable. How do companies use the Profitability Index (PI) to assess investment proposals? Companies use PI to compare projects based on the value created per unit of investment, helping rank them by financial attractiveness. How can sensitivity analysis assist companies in managing risks in capital budgeting? Sensitivity analysis helps evaluate how project profitability may change under different market conditions, allowing better risk management.